This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial, and today we're going to talk about a subject of inheriting an IRA. Now, before we talked about spousal inheritance, but today we're going to talk about a whole new beneficiary. And joining me today is Caleb Doane, their Vice President. Hello, Caleb.
Hi.
How are you?
I'm doing well. How are you?
Happy Monday.
Yeah, happy Monday.
Good. Okay, so that was an interesting topic that we had. We had a two-part conversation about spousal inheritance. So what is the topic for today? Like, who will receive this IRA?
Yeah, we're going to talk about kids now.
Okay.
So usually that's kind of the process that we see, is that we have two spouses, they're each other's 100% primary beneficiary. So if one spouse passes away, they leave it to the surviving spouse, and then when they pass away, it goes to the kids. That's the typical process. And we talked a little bit about how when an IRA goes to a spouse, it's usually a pretty seamless process. It can go into that spouse's IRA almost as if it was always their IRA in the first place. There's not a lot of additional rules that are attached to it. But when it goes to the kids, that's not the same case. The IRS likes to add a bunch of rules and requirements.
Of course.
Always, right? And those rules and requirements have changed quite a bit over the last 5 or even 10 years as well. So I wanted to touch on things that people should be aware of, especially as kind of the baby boomer generation ages in retirement. There's going to be a lot of IRA assets that get passed down, and it's important to make a plan for it.
Okay, so you mentioned those levels that the IRS likes to put on this type of inheritance. So what makes it complicated when it comes from the parent?
Yeah, so it used to be the case when an IRA was inherited, there were required minimum distributions associated with it, but you could stretch out those RMDs over your entire life. So if you inherited, a $100,000 IRA from a parent, there was a very small amount that you had to take out every single year. Let's just say $1,500 every single year. And usually at that withdrawal rate, that could last your entire life. And there wasn't a specific, date that it had to all be cashed out by or anything like that. It's just a small amount you had to take out every single year. Now that has changed, and so the IRA that you inherit from a parent has to be cashed out within 10 years. So there's kind of a complicated rule that they have, but they say it has to be cashed out by December 31st of the year containing the 10th anniversary of the original owner's death. And that's a mouthful, but that's the rule that the IRS has.
Okay, so with that comes penalties, right? So, or at least you're having to pay the taxes on it. So as you said, they could spread it out, but now it's almost like a lump sum, broken up into 10 years, but more expedited. Rules to get the money. Now, is that so much a bad thing? Do most kids really take that money out within 10 years anyway?
Yeah, there certainly are folks that do that. I'd say people can kind of err on two sides of the same coin here.
Okay.
There are, kids that will cash it out all in year one, right? Because they get it and they're like, hey, there's a lot of rules associated with this. Let's just cash it out. The issue with that is when it comes out, it's taxable. And so you're paying all those taxes not only just in 1 year, but probably in a higher tax bracket because it kicked you up into a higher tax bracket in that year. There's also
income. It's
right. It counts as income.
Income.
Ordinary income in the year that you cash it out.
And when you're younger, like you've always taught us, that is a higher tax bracket.
Yeah, if you're in your working years, you might be in a higher tax bracket already, and then that kicks you even higher. There's also, the very well-meaning children that say, hey, mom and dad, had this invested, I should just leave it invested, and they just let it ride, and then maybe they inherited $100,000, and then it grows to 200 by year 10, and then they're like, here's something that says they need to cash it all out. Now they're cashing out $200,000 all in 1 year. It can kick them up into a higher tax bracket as well. So a lot of times we want to make a plan for a withdrawal in each of those 10 years. Maybe we look at how much room somebody has in their current tax bracket and we say, hey, you've got $20,000 of room in the 12% tax bracket. Let's cash out $20,000 every single year to stay in your tax bracket and still get it cashed out by year 10.
Okay, because you're kind of like playing with that max. Therefore, it's not going to bump them, but they can get enough Is there any other like loopholes or ways that they can roll that over into another type of retirement account and not have to pay any type of taxes at the time?
That's a great question. So yeah, that's part of the planning that we'll do for clients too. Especially, let's say that they're already at the top of the 12% tax bracket, and any additional withdrawal that they take from this inherited IRA is going to push them into the 22%. What we can do is, take a withdrawal, let's just say $10,000 from the inherited IRA, and then we take that money and we contribute it to this person's 401k, pre-tax, let's say. And so if you contribute pre-tax, it lowers your income. So you're raising your income by 10 grand by taking a withdrawal, you're lowering your income by contributing it to your 401k at work. And so we can kind of use that to offset, to make sure that you're not paying too much in taxes.
Interesting. Those are a lot of rules, but it's a good thing we have a financial advisor like you to help us break it all down.
Yeah.
Well, thank you, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, you can actually go to their website or their phone number that's listed below to set up your complimentary consultation. And I'll see you after the break. This segment sponsored by Foster Financial.